In this video, we're going to talk about price action rules and why it is so important to have understanding of these rules. Why price action rules work? It's simple. It's because markets reflect a human behavior, a human greed and fear. And since the core human behavior hasn't changed and most likely will not change, market will continue to move in the same way and will continue to form the same patterns again and again. Most retail traders are unaware of the fact how price actually moves on the chart. And why is that? It's because average trader gets first introduced to information that will do the complete opposite of what he should do to educate him. Most traders at first look for systems that will do the work for them, and they will look for indicator-based strategies. But as most traders already know, this is a fool's errand and indicators don't work. They only show past performance. All these fancy indicators look great at first, but the only thing these indicators do is they clutter your chart. Having all these indicators on a chart will stop you from learning about the true movement of price, and it's going to be next to impossible to get the proper understanding about the price movement. Only when you start to focus on raw naked price action, you will understand how price actually moves. Since markets are not random and there is a reason to how price action moves, there are rules that will help us to stay on the right side of the market. And the first rule is the trendline rule, which says after break of a trend line, which means that the candles will close outside of the trend line, new extreme is going to be formed. And after new extreme is formed, we expect correction phase or possibly straight up reversal. Now we have a downtrend looking structure on the chart. So as price action traders, we want to find a pattern because price action is never alone and naked on the chart and is always contained by some form of a pattern. You guys can see we have a nice bearish downtrend working lower and we have a triple confirmation of this downtrend. So at this point on, the structure is bearish and trader is only looking for short opportunities. Notice what price created. There was a break of this channel. There were candles that closed outside of this channel. Most traders will take this information and they will think that the trend is over and they will start counter trend trading. They will start looking for buying opportunities. But at this point on, according to trendline rules, we know that we cannot go long just yet. This downtrend needs to get new low. It needs to get a retest of this previous low. And notice what price created. It created move to a new extreme. And after new extreme was formed, then we expect correction or possibly straight up reversal, and price in this instance straight up reverse. And this is the uptrend now when you're safe to be looking for buying opportunities. So this is the rule number one. When you're following the trend line, you're only looking for longs after you get a proven trend in opposite direction. And after you have a break of a channel, you expect new extreme to be formed. Same thing will apply for the shortened channels as well. Notice as there's a downtrend working lower, there are shortened uptrends in between. And these uptrends at the same time have a break and retest of a new extreme, or at least attempt to create new extreme. Break new high. Only in this instance, there is a break, no new extreme form, but that's because the downtrend is just too strong. But you expect the same thing to happen even on a micro level, even for these corrections. After a break of uptrend, you expect new extreme to be formed. And then you know that this uptrend is over. So this is the trendline rule. Bullish uptrend working higher, break of the channel. And the trendline rule says that after break, new extreme